how I protect my portfolio in a bear market. In this video, I'm going to break down what to do in a bear market and how to play a bear market so you don't lose all your money. Remember, this is according to my own research. This is not financial advice. If you want to keep up to date with markets, I do have a free newsletter. Link to that will be in the description. Look, you can't avoid all losses, but you can avoid the worst ones, right? So nobody can guarantee zero losses in a bear market. You can't, guarantee the fact that you may lose some money. That's predicting the future, which is what you can't do. What you can control is the size of the damage. A 20% loss on a well-sized position in a quality asset is recoverable. A leveraged asset, for example, it puts yourself in a bad situation. And the goal is to not avoid the bear market, it's to survive with capital intent. You want to be preserving capital in a bear market. You can't avoid it and just say, yeah, I'm not going to play for the next couple of years, I'm not going to invest, whatever it may be. You want to just be thinking, okay, cool, these are the conditions. How can I best play it with keeping as much capital as possible until bullish conditions return? And you can't predict when bullish conditions return. So ultimately, a plan before the bear market is everything. A plan during one is too late. So you want to maybe not phrase it as much as, bull and bear market, but you want to phrase it as, okay, cool, what is the bearish condition? What is the bearish trend? What is the bullish condition? What is the bullish trend? I think that's a much better way out to kind of, separate the two than have that bias of a bull and bear market. Have a plan before it starts, not during it. So as I mentioned earlier, define what conditions you would reduce exposure before the market falls. So we spoke about that. This could be easy. Above the 200-day moving average, below the 200-day moving average. Right? This isn't acted on feelings, headlines. It's a condition on the chart, that you can follow. Right? You can do this in so many different ways, but that's an example. I spoke about this a lot. A study done, in the past, which I've done another video on about why this data changes everything, or is there a need to be active investing? It talks about the fact if you were to avoid the 25 worst days in the S&P, you'd be much better off as you were to just buy and hold. Now that's obviously very hard, but most of them happen below a 200-day moving average, so that could be an easy way to do it. Without a plan, you will start at the bottom and miss the recovery. If you just sell on fear, and that's usually what people make, bad decisions, fear and emotion-based investing, you're going to just sell at the exact wrong time. And the plan removes the decision from an emotional moment or whatever it may be. So if the conditions are not met, you stay in and you act. So you want to just have a plan. You don't want to be doing anything on emotions. And the plan also tells you when to add, not just to reduce. So you might think, okay, cool, I'm going to risk more because we're above the 200-day moving average. I'm going to start to build positions again. The bear market does not give you time to think, prepare now. So bear market could come tomorrow. Your bear market could come next week. And I don't think it's as dramatic as I put, actually. I think you've just got to say what are bearish conditions, what are bullish conditions, and how do you define that, and how do you play? Are you going to have, in a bull market, dry powder to go in at the bear? But that opportunity may never come. So, yeah, you really want to kind of decide what you want to do. Position sizing is everything. Size the position so that the normal volatility does not force an emotional decision. So if a 20% drop occurs, you're not forced to sell. This could be maybe in a stock. Maybe you bought Amazon before, or Meta. They had huge declines, and they Meta in 2022, and you may have thought, right, I'm going to stay in. I'm not overly, positioned in this stock, whatever it may be. It's a small chunk of my portfolio. And you've got to have that mentality that you're going to be okay. And if you're not overly positioned, you won't feel as kind of nervous when you're in it. The size determines whether you can hold through the noise. So that's something definitely that's important to think. Like, most people who sell at the bottom do not because they change their view on the asset. They sell because, they can't bear to be in that position anymore. And a lot of future millionaires are made in crashes. So a lot of people would have really benefited from that lost decade in the S&P. A lot of people would have benefited from COVID. Why? Not because they're geniuses, because they got in or they accumulated at really good prices before a huge move. The lost decade is a great one. If you were bullish on America and you were accumulating the American index, you would have done exceptionally well. That probably was the best trade of the century so far, just accumulating in that zone and just buying and holding and just letting it ride out. But, there may be somebody did that in another country or whatever, and it's not worked out so well. So you've got to have that conviction, you've got to have that plan. But a lot of people would have benefited from that 2008 crash because markets recovered and they covered really well. And remember, you only lose when you sell. So that's another thing to bear in mind. You only lose money when you actually sell. But ultimately, you never size a position so large that you cannot survive being wrong. Find what is working. So one thing that I like to do is relative strength in a bear market. So think of example, a bear market in stocks does not mean everything falls equally. Gold in the 2000s, you've got copper, now energy stocks, whatever it be. Every market turn has a sector and asset class that is showing relative strength. So stocks bear market, but you've got other things going. And then to add to that, you've got gold now and silver. They've dropped massively. Copper's held up. Okay, cool. Could this be something I want to put more time into, research and whatever it may be? What's the ratio? So one thing that's good to do is you could do Nvidia versus the Nasdaq. Is that showing relative strength versus the index? Or you could do maybe Sol versus ETH or Sol versus BTC. If it's showing relative strength against its index, okay, cool. And there's so many ways to do that. This could be an earnings model. You could do it from charting. You can just do Nvidia, Dash, and then the Nasdaq, put them together, and you've got the chart. So the things that are holding well against its peers in a bear market, you could argue they're going to be the leaders out of it. Screaming bear market is not actionable. I've spoken about this before, right? So saying a bear market's coming, a top's coming, it doesn't really make you any money. Like a plan around it does. So finding what is working in a bear market is. So the investor who's watching relative strength, or the investor who's got a plan in place, is going to do well. So the bear market is where the cycle's leaders reveal themselves, or the next cycle's leaders. A bear market is a chance to lower your average entry. Again, the lost decade I spoke about was one of the best opportunities probably of the century, especially some of those big crashes. So it didn't make any all-time highs, but if you were just accumulating, you would have done great. Short term, is never the right way when it comes to anything. Short term thinking, in investing, to take the lost decade, for example, short term, oh my God, like I'm down from my 2003 or 2005 investment, wherever it may be. Like if they just stayed in, didn't sell, they would have done very well, right? So that's the mindset and attitude you've got to have, right? The long-term opportunity in things. A bear market, compresses value, and that compression is the opportunity. Quality assets, they drop, they have better value. People will be loading the boats, you could say, on stuff, but you've got to do it with a plan. But a bear market does create really good opportunity. It just lowers the price for everything. It's like, great, everything's on fire sale compared to what it was maybe 1-2 years ago. So build a watch list before the crash, build your process, and then watch things fall, and then you can start to make those decisions. The verdict is have a plan. Everything comes back to having a plan. Size position correctly, no leverage or very little leverage, in a bear market. Obviously, you've got to understand leverage if you are going to use it, but ultimately you should be using no leverage. Watch relative strength, find what is working and not just, what is falling, right? You want to find, stuff that is showing that relative strength compared to its others. A bear market is not a threat, it's an opportunity to lower your average entry. Really important frame. A bear market can really be almost your best investment because you just get that best risk to reward because you can just buy it and do nothing. So look, all this considered, I hope this was actionable for yourself if a bear market is to come soon. If you want to keep up to date with markets on a weekly basis and navigate future bull and bear markets, I do have a free newsletter. Link to that will be in the description. See you in the next one.